Ladies and gentlemen, good day and welcome to Ashok Leyland Limited 2Q FY23 post-results conference call hosted by Batlivala and Karani Securities Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Annamalai Jayaraj from Batlivala and Karani Securities. Thank you and over to you, sir.
Thanks, Vivian. Good afternoon, everyone. On behalf of B&K Securities, welcome to 2Q FY23 post-results conference call of Ashok Leyland Limited. I also take this opportunity to welcome the senior management team of Ashok Leyland Limited. We have with us today Mr. Dheeraj C. Hinduja, Executive Chairman, Mr. Gopal Mahadevan, Full-Time Director and Chief Financial Officer, and Mr. K.M. Balaji, Deputy Chief Financial Officer. I will now invite Ashok Leyland Management for the opening remarks to be followed by question and answer session. Over to you, sir.
Thank you. Good afternoon, ladies and gentlemen. It gives me immense pleasure to be in touch with you, and I thank you very much for the interest shown in Ashok Leyland. I will quickly run through Q2 performance as well as some of the latest developments. I'm extremely happy to share that Q2 FY23 continued to be good, aided by a strong performance in domestic truck sales with a 32% market share. This is almost a 10% increase over our market share during the same period last year. This is the third consecutive quarter of 30-plus market share for Ashok Leyland. In Q2, MHCV truck volumes have grown more than 1.5 times of the industry growth, AL growth at 102% versus TIV growth at 39%, resulting in Ashok Leyland market share improving to 32.3% as compared to 22.2% in Q2 of last year. Sequentially also in Q2, AL's MHCV truck market share has grown by 1.2%. Our market share has grown to 32.3% in Q2 from 31.1% in Q1. EBITDA for Q2 was at rupees 537 crores, 6.5%, as against rupees 135 crores, which is 3% in Q2 last year. LCV, which was on a growth phase, has been marginally impacted by semiconductor shortages, but for Q2 volumes, were still higher than last year by 28%. International operations sales have registered a 25% year-on-year growth in Q2. Q2 domestic aftermarket sales grew at 26% over same period last year. The Q2 operating profit was at rupees 303 crores as against the loss of rupees 116 crores in Q2 of last year. Working capital has increased by about rupees 650 crores during the quarter, primarily due to increase in activity levels. Consequently, our net debt has increased by about rupees 400 crores in this quarter. Debt equity is at 0.4 times versus 0.5 times during the same period last year. During the quarter, we have launched 4825 tractor with 8.6 4-valve engine, Avatar 4220 and 4420 tractors, 4120 30-foot and 32-foot, Boss 1920, Cargo 6x4 ready-mix concrete, 1920 with G45 FES expanding our range. I'm extremely confident that with these launches and the continued expansion of network, we will sustain the market share gains achieved in last 4 quarters. The growth in MHCV trucks TIV in Q2 and LCV trucks is supported by the improved freight availability and growth in end-user industries, in addition to pent-up replacement demand. Freight rates have held up, coupled with healthy freight availability supporting the fleet operator viability. Domestic commercial vehicle industry volumes to witness growth in FY23 in line with economic recovery, post-volume recovery in FY22, FY23 is set to register 22 to 24% year-on-year growth as per CRISIL, though volumes will still be lower than the previous peak of FY19. MHCV trucks are expected to grow by 21 to 23%, buses by 103 to 105%, and LCV trucks by 18 to 20% as per CRISIL. On a longer term, CRISIL expects commercial vehicle demand to grow at a robust 10 to 12% CAGR for a 5-year period between FY22 and 27. Historical data shows a high pace of revival in commercial vehicle demand in the past. Demand for CVs to remain robust in the long run. CRISIL expects bus segment to outperform in the long run over a low base. This will add to our volumes and market share, as Ashok Leyland is a leader in buses historically. With further demand growth, we are expecting pricing to become more rational. The softening of commodity prices, in particular for steel, should impact the margins positively in the coming quarters. Ashok Leyland, even while growing market share sequentially, has been raising prices owing to higher input costs. What is good to see is that retention of such price increases is better. LCV, both DOS and Barados, are gaining inroads and have been growing stronger by the day, and volumes are limited by the availability of semiconductors. Both these products hold immense potential for exports and are a perfect fit in our addressable market. Aftermarket and international businesses continue to perform well. We are also putting efforts in reducing costs, both product costs as well as overhead. Switch, which is an important initiative for us, I would like to reiterate our commitment to developing Switch as a global electric vehicle company. So far, we have been successful in establishing a name and a platform as a credible EV manufacturer in the industry. You are already aware that in India, we are growing our sales pipeline quickly and delivering a competitive product range. In the UK and Europe, there is headroom for growth. Amidst challenging economic environment, we are chalking out our plans to utilize these growth opportunities fully by placing higher quality, cost-effective products. Regarding funding for Switch, we are in active discussions with investors, and it is taking longer than expected, as we would like to choose the right partners. Finally, before I open the floor for questions, let me share the financials in brief. Revenue for Q2 at rupees 8,266 crores, which is 85% higher than Q2 last year. Manpower cost in Q2 is higher than previous quarter by rupees 82 crores due to increments, bonus settlements, and performance bonus provisions restatement. EBITDA is at rupees 537 crores, which is 6.5% in Q2, up from 135 crores. Profit after tax after exceptional for the quarter was at rupees 199 crores versus a loss of rupees 83 crores in Q2 of FY22. Operating working capital for Q2 was at rupees 490 crores as against the negative of rupees 167 crores as of June 22. Increased activity levels have necessitated increased working capital during the quarter. Net debt was at rupees 2,677 crores in September 22 as against rupees 2,281 crores in June 22. Debt equity at the end of the quarter was at 0.4 times. Capital expenditure for the quarter was at rupees 103 crores. Cumulative spend for first half was at 618 crores. 218 crores. CapEx spend for the full year is estimated to be rupees 600 crores. I now open the floor for questions. Thank you.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Participants who wish to ask a question may kindly press star 1 on your touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Pramod Kumar from UBS. Kindly proceed.
Yeah, thanks a lot for the opportunity. So my question is regarding some ICDs which have cropped up again. Can you please help us understand why we are doing those and the rationale for continuing to lend within the group when we also have debt on the balance sheet? So if you can just explain that bit, please.
Yeah, hi Pramod. This is actually, because of disclosure, we have to mention it that way. This is actually a short-term loan that has been given to our own subsidiary Switch, and nothing more than that. So the entire amount of 200 crores has been given at for kind of helping them execute some of the orders that they're getting. Switch has got some great orders in place, the BMTC, the BEST double-decker, plus the existing orders. So that's what it has been given for. It has not been given for any other group company. It's to our own subsidiary.
But Gopal, I'm just trying to understand the funding bit here because we've been talking about raising money at Switch for almost a year now. So what is the way out if you're not able to find any private equity investor at your terms? I believe it's more about the terms and the restrictions which come with those funding, right? So is there a plan that you may think of eventually funding this yourself by raising equity at Leyland's level?
Pramod, hi. No, I think like you rightly said, there is interest in electric vehicles from many private equities and sovereign wealth funds as well. We have been delayed, as you point out, but we do feel that this delay, one, should not affect the long-term potential in this sector. And secondly, I think it is only right that we should get the right terms, conditions, valuations, etc. The EV sector globally, as you would have seen, has taken somewhat of a beating because many companies had raised capital at substantial valuation. We have taken a very cautious approach. I think our business plan is very credible. And I would say that we do have opportunities of closing the funding, but I think it would be in the interest of all investor stakeholders to ensure that we do tie up with the right partners.
And related to it, and the last question, given the expected price inflation on the diesel vehicles because of RDE and the fact that CNG demand is now tapering off because of runaway CNG prices, so is there any timeline or thought process on accelerated rollout of EVs, especially in the light tonnage categories, because that's where the electrification is kind of picking up very rapidly. So Dheeraj, it would be great if you can just share your strategy here as to by if any timelines on number of product launches or categories which you'd like to address using the EV format. Thank you.
Yeah, actually, this is something we had spoken of last time as well. We will be launching the electric versions of the Dost and Bara Dost in the middle of 2023. And you're right, we see increased requirements from many courier companies, logistic companies within cities for last mile delivery. They are asking for electric vehicles. But I don't feel that when you look at the overall volume between where diesel is today, let's say between 400,000 to 500,000 LCVs, while the electric vehicles are making a headway, I still believe it's a long way till you really look at affecting the diesel market. So yes, there is growth, there is potential, but I do feel that this will be a slow rise and it'll be more a B2B business to begin with rather than retail.
Just to add to what Chairman said, Pramod, we will be definitely there in a multi-play approach. So our investments in EV, which is why we are very, very careful about the investor that we want, because this is long-term play. Whatever we seed the business with today is what we are going to have in the future. So we have decided, like Chairman said, that we would, want to get the right kind of investors, and rest assured that just as we have, got onto the EV bus, business and have been doing well, we have very clear plans for LCV as well.
Yeah, thanks a lot. Thanks a lot, both of you. Best of luck. Thank you.
Thank you. The next question is from the line of Jinesh Gandhi from Motilal Oswal. Kindly proceed.
Hi. My first question pertains to the pricing trend in the market. So you alluded to the fact that prices have been increased and retention has been better. So can you quantify that in terms of what kind of price increases we took in 2Q and 3Q up till date, and how are the trends on discount?
In Q1, I think, Jinesh, we have been actually raising prices. That's why, just wanted to give, if you look at our EBITDAs in relation to the market, you would see improvement even though we are playing in the same field, right? And this has been because of a conscious effort of 2-3 things. One is price increase, where in Q1 we did about 1.8, 1.9%. In Q2 we did another 1%, and very recently we have announced almost another 1.9% price increase, 1.5%. So we have been consistently raising prices, and we will continue to do that. But at the same time, if you notice, we were the only large player to have gained market share in Q2. We were the only players in MHCV to have gained market share. So this has come very, very astutely. And why this has come is also because we have been, as Chairman and I had mentioned in our previous calls, we have been refreshing the network very intelligently, bringing in partners who are confident of actually scaling up in some of the regions up in North, East, Central, and West. And I don't know whether you folks have noticed that, again, not only have we grown significantly, not only have we raised prices, we have increased market share, and more importantly, we have increased market share in all geographies. North, East, West, Central, South, we have actually increased market share all through. So this has been a very, a very planned and systematic approach of growth instead of just looking at either market share or profitability. Like Chairman repeatedly says, we want to grow. Certainly we will grow, but we will grow profitably.
Got it. And are you seeing discounts coming down or at least stabilizing given the demand environment in which we are in?
It has been almost stable between Q1 and Q2. Marginal differences have been there. But we are trying, what we are trying to do is to not participate in increasing it any further. Because one of the other points that I wanted to also share with you, which is another, kind of force multiplier for us, is the excellent performance of the Avatar range of products. When we are meeting customers, the feedback on the product is not neutral, it is positive. People are extremely happy with the robustness of the performance of Avatar range of products, the mileage that some of these SKUs are offering, and which is why we are also able to get a slightly better realization. We had mentioned in 2020 that we will slowly start seeing the benefit of modularity and the technology that we are offering, and we're seeing that on the ground happening today. Hopefully discounts will start coming off, if as the industry realizes that this has been an industry which has seen good cost increases, from BS4 to BS6. And then the steel price increases which happened, which are now slowly coming off. So hopefully we are expecting that discounts should kind of square off now.
Sure. And there's a sharp increase in our staff cost on YY and QQ basis. Is there any one-off or just it's in line with the level of activity which we had?
Staff cost is, what we did, and we have decided that we have internal, plans for a bonus which are performance linked. So we have actually kind of increased those provisions as well in the current quarter. And the second one, so we, that has stepped up. We had been very, not conservative. We had taken a view in Q1, but we believe that, things are getting better. And we wanted to ensure that we start providing for it in Q2 itself instead of waiting for Q4. We'll make any adjustments that are required in Q4, depending on the achievement of the internal targets. The second bit that has happened is obviously we have, our teams have been working hard over the last 2 years, even 3 years without any raises. So the leadership team felt strongly that we needed to give salary raises to employees this year because it has been nearly 3 years of hardship. The third one, which Chairman had mentioned in his opening comment, was also on the settlement of workers that we needed to do, so that has also got accrued. Otherwise, we have, one thing that we are very careful about which we are investing heavily in technology as well, is improving manpower productivity and ensuring that we're not adding to manpower.
Sure. And lastly, any indication of RM cost influence in 2Q and what you expect in 3Q?
Yeah, I'll just give you a quick thing, and Chairman, you may want to add also about the initiatives that we are doing on the procurement side from the strategic side of it. Steel prices approximately, had risen by about 5 rupees a kg in Q1, and we actually saw almost a 10 rupees decrease in Q2. 5 rupees vis-a-vis what existed on 1st of April, and then it came down by 10 rupees in Q2. It looks like prices are softening further, which is good for us. And, we'll continue to monitor this, but we are expecting that steel prices, should continue to soften as we move in the second half as well. So now, Chairman, would you also want to add about what we're doing on the, on the sourcing, the manufacturing product cost front?
I think the key thing is that margins need to keep improving, and as Gopal mentioned, products are performing very well, and that is what's leading to the market share gain as well. But there is a lot of initiatives internally where we're looking at cost reductions, again, as Gopal mentioned, improving productivity. Naturally, material costs, we are, with the volumes increasing, the economies will start kicking in as well, hopefully with some of our larger suppliers. So we do feel going forward, with the softening of some of the commodity prices, this should help as well. And of course, with the LCV volumes, we do have an initiative, on the value engineering of the products itself. So all I can say is that many initiatives going on internally by the senior team to ensure that the margins on the products would be much healthier.
Got it. Thanks. I'll fall back into you.
Thank you. The next question is from the line of Kapil Singh from Nomura. Kindly proceed. Mr. Kapil Singh, you are unmuted. Kindly proceed.
So, thanks. Can you hear me now?
Yes, we can.
Hi, Kapil.
Hi, sir. So, sir, I have two follow-ups, small ones. On the employee costs, are you saying that the Q2 level is what will sustain going ahead, or is it the H1 level?
Well, we'll figure it out, because I think what will happen is it will be somewhere, the truth is somewhere between Q1 and Q2. The reason is we did a catch-up in Q2, right? So Q2 has taken possibly the full impact of, the catch-up that needed to be done. So we will see some softening in Q3. So the numbers will be somewhere in between Q1 and Q2,
Yeah. And second, on the commodity costs, because, the RM to sales has seen an improvement of about 100 bits or so, right? Hello?
Yeah. Oh, sorry, Kapil. Just wanted to say that the manpower cost absolute, while you look at it, the other thing is we are also expecting the growth in the industry, right? So we possibly will see growth in the top line as we move forward into Q3 and Q4. So when you look at a percentage to revenue, we believe that will actually come off. I thought I should clarify that. Otherwise, absolute manpower cost is one part. Yeah. Okay, back to you.
Yeah. Thanks, sir. So when I look at the raw material to sales, it has seen some drop, nearly 100 bips. But you took up prices by 100 bips, and you also mentioned that the steel price during the quarter came down by 10 rupees. So I imagine the benefit should have been larger, or were you carrying inventory and therefore you've not got the full benefit of that drop in steel price as a
So I would have been disappointed if an intelligent person like you did not ask that question, but the point is you also had the answer for it. We have inventory of raw material and WIP and FG, so that needs to be sold out, and that's one of the reasons why this we have not seen. And see, we must also remember another thing. While the team is pushing to a favorable mix, which is this business, the larger the vehicle we sell, the more is the margins, right? But as an industry, you will also see that ICV is catching up quite a bit. So, we need to ensure 2-3 things. We need to ensure that we are serving our customers for the entire suite of products they want. We have to ensure we are gaining market share in the, equitably in all the regions. The third one is we also have to ensure improved profitability. So what has happened is the opening stock which was there obviously had to be sold out. And, we need to, our guys in procurement side have to continuously peer into the future to see whether we need to buy more, should we, defer purchases, etc. But at the end of it, in this quarter, you have not seen the full benefit of it because of the opening stock. Possibly things will look better in Q3 and Q4, definitely.
Great. And so one question I had on the debt as well, and CapEx actually along with that. So earlier we used to talk about CapEx being somewhere around 1,500 crores and some investments of 300, 400 crores as well. So when we look at the business going forward, what is the steady state of CapEx and investments that we should look at, say, next 1 or 2 years? And also, from a debt level perspective, there is some increase in working capital as well. How much of it do you think you could realize by or revert by end of the year? And by when do you see yourself turning debt free?
We had never had capex levels of 1,500 crores. And I think going forward as well, as I mentioned, 600 crores is what we foresee for this year. Majority of the capex that we had envisaged happened already with the Avatar, the BS6. And so going forward, I would expect our capex to be in that range of 500 to 700 crores. Because the product range is already in position, and the incremental capex that we move forward with will hold us well for the future product ranges as well. On the working capital, Gopal, would you like to comment?
Yeah, I would only mention one thing, while we will continue to endeavor to improve our working capital, and the debt level positions, I think our working capital situation is not at all bad. The working capital situation is actually pretty decent for the industry that we are in. We are having what happens is we are also having, when the market is growing like this, we need to keep some ammo ready. So we keep our inventory levels slightly higher because if there is an upside in sale, we need to be able to provide those volumes to the sales and marketing team if there is a quick upside that comes in. The second is, as we mentioned, as the revenue numbers actually start going up, you will see that, the receivables start to go up a bit because we are not getting back into cash and carry immediately. At the same time, I just want to kind of assure you, at the senior leadership level, among the various matrices that we keep almost looking at on a daily basis, receivables and inventory is one of them. And we are ensuring that receivables are monitored efficiently. We have no concerns on that, but we need to ensure that we are paying out the rope to our dealer partners to actually, make the sales in the market, and that has also helped. It has been a positive effect. The working capital that you're seeing has also been one of the reasons that has helped us in actually enhancing our market share. Having said that, we keep a close watch on cash. Our debt, as Chairman had mentioned and Balaji had mentioned, our debt to equity is just 0.4, and possibly by the end of the year, if things go as planned, we would see a significant reduction in the debt levels. All of it, by the way, is only short term. We don't have any, long and short term mismatches. We keep our long term funding separate and the short term funding separate. But you would see possibly that our debt levels will come off quite sharply by the end of the year if things go as planned.
So, sir, this 600 crores includes the electrification capex also, and what is the investment plan for next 1 or 2 years?
Yeah, I'll just quickly share it and hand it over to the chairman. As far as electrification capex is concerned on the buses and the light commercial vehicles, all of that is housed under switch. So this 600 crores does not include that. We are, as chairman had mentioned, we are, actively pursuing capital raise and possibly will share some news. But we are not factoring in any further support to switch at the current moment in the 600 crores. And all of that will be short term, by the way. But as far as other capex is concerned, we are now actually pared it down. If you remember, we had started the year with 750 crores. I think the team has come back and said that possibly it's more a realistic number of 600 crores. But as on date, in the midpoint of the year, we are hardly at 214 crores. Chairman, yes.
Yeah, just to add on, as we have said for Switch, the requirement over the next 2-3 years is close to $200 million to $250 million. And this would be for a range of buses and LCVs. And within the overall capex, since you asked about electric vehicles, Ashok Leyland would be looking at electrification of its truck range over the LCV range. So the ICV and upward products, that would fall within Ashok Leyland.
Okay. Thank you so much.
Thank you. The next question is from the line of Amin Pirani from JP Morgan. Kindly proceed.
Yes. Hi, sir. Thanks for the opportunity. My first question was, largely a clarification on the upcoming BS6 Phase 2 norms. So, A, what is the kind of cost inflation you are anticipating? And B, is the implementation similar to what happened during BS4 to BS6 in the sense that will you have to clear all the inventory at the dealer end, which could lead to a few months of destocking and wholesales coming down? So if you can clarify that first.
I mean, let me clarify the latter part of it first.
Yeah.
Ensuring one thing, this is not stuffing the pipeline.
Okay.
And we have said that in the past. So we never stuff the pipeline. Stuffing the pipeline happens when your wholesale inventory is more, where the, the retail sales are lower than the wholesale sales, right?
Yeah.
In our case, the retail sales will be equal to wholesale sales.
Okay.
In some, actually the retail sales are more than the wholesale sales, which causes a concern for us. Because then what happens is there is no sufficient inventory in the pipe. And you see, the other thing that has happened, while we are looking at this, the working capital has also gone up. You know why? Because earlier we used to have regional centers for distribution. So suppose a dealer wanted a vehicle, all he had to do was to ask the regional center, and then the vehicle will be shipped almost overnight to him for him to make the sale. We used to carry the inventory not on their behalf, but that is, we had a distribution which was different pre-GST. Post-GST, what has happened is, to look at, the overall cost-benefit analysis, we at some point in time had said that no, we will actually kind of close most of the regional centers and actually start selling to the dealers from the factory, which means there is almost at any point in time, there is an 8 to 10 day WIP work in transit to the dealers, which is to the dealer's account, because you're cutting an invoice, right?
Yeah.
That adds to the inventory which is shown as receivable. Actually, it goes to receivable part. The second part of it is the dealer also stocks up a bit because he is not sure about the immediate serving of the requirement given the distance that is there. What we are doing now is, having seen the efficiency that GST has brought in, we are really looking at whether we should have central distribution points so that will kind of help to keep the working capital more in inventory than receivable, because once you cut an invoice, then it goes into the dealer receivable. To answer your question, there is nothing that we have to worry about destuffing at the moment, because our retail sales are same, if not higher than wholesale. And your first question was on the OBD2 requirement that is there. Here we are working on this, but I think we'll have to come back to you a little later on exactly what the cost impact is, because we are working on options on this.
Sure. Thanks for that. And my second question is that, the feedback that we're getting from the ground, regarding one of the reasons why your market share has improved over the last 2 to 3 quarters is that as your BS6 offering has ramped up, and I think partly you answered it in the avatar question also, it seems that you are able to offer a lower cost solution on the BS6 side. So first of all, just wanted to get your sense, is that correct? And B, how have you been able to achieve that and how sustainable that is? Thank you.
You're right. As customers are increasing the use of the avatar product, they're recognizing that the total cost of ownership and fuel, the mileage that they're getting is much better than competitor products. And I think this is a result of the overall development that happened during the BS6 process itself. And you look at the consumption of not only the diesel, but the AdBlue as well. So combined together, we are seeing a much better economies, fluid consumption than the competitor products.
Okay, sir. Okay. Thanks for that. I'll come back in the queue.
Thank you. The next question is from the line of Chirag Shah from Nuvama. Kindly proceed.
Hello. I hope I'm audible.
Yes, sir.
Yeah. Sir, I have joined slightly late, so apologies in case I'm repeating the question. Sir, anything on the defense revenue plus engine revenue in the quarter, and how it has moved sequentially, Q1 versus Q2?
Yeah, Balaji, do you want to give the...
There's not much of revenue on the defense side, Chirag. It is around 50 crores per quarter.
But just wanted to share with you, Chirag, the reason why it's happening is not because of any concern. This is a very government, Ministry of Defense offtake driven business. So, we are expecting that the offtake will start in the second, third and fourth quarter, yeah. So this is, see, what we will do from the defense side, we are far well positioned, more well positioned than we were 2 or 3 years ago. Because 3-4 years ago we had only the VFJ kits and the Stallion kits which were there. Now today we have multiple products available, including medium bulletproof vehicles, light bulletproof vehicles. We are transporting, we have got vehicles which will transport missiles. We have got vehicles where 2 of the large infrastructure providers, I can't name them, had chosen Ashok Leyland as the vehicle which will carry the transportable bridges, the retractable bridges. So there is a lot of technology that has come in, and both in armored and non-armored trucks. So once the government starts to make these orders, we believe that we are going to be pretty well positioned to serve it, and you'll see our defense revenues actually getting better. Chairman, would you want to...
Yeah, I was just going to add, as Gopal said, we do have a good order book, and the indications are that effective Q3 onwards, we should be able to start delivering. So you will see by the year end, the defense volumes and revenues would be much higher.
Yeah, actually you answered second part of my question. Sir, my question also was that for these futuristic products, now as an industry, everybody has been waiting. Any update or clarity that is emerging that now the defense, these revenues will start flowing in? Because earlier expectation was somewhere in 22 or 23, the revenue from defense, wherever you have seen technical approvals and trial runs have been done, would start flowing in. So is it on course or there is any delay? Any update if you can share would be helpful.
See, what has happened, Chirag, we've as a country, of course, there is a for a defense business. I mean, security across the parameter of the country is actually pretty needed. The second bit of it is that the government has been tackling COVID and its aftermath over the last 2 years. So while they have been actually looking at defense, the procurement has not really started. Now, what we have seen, the recent announcements also is that, the government has been talking about the defense preparedness of the country. I mean, as a normal strategic initiative, I'm not saying that there is anything to get worried about, but we believe that the procurement will start, as Chairman had mentioned. We are expecting that the procurement will start happening. But, these things are not something that we can predict so accurately. We can only predict a trend, and we can continue to invest in the business, which investments are not very high, by the way. So what we are doing is we are offering various vehicles for applications, and we are keeping it ready. We are getting it certified by the Ministry of Defense, and we are keeping the offerings ready. We have, won the tenders also, but now we'll have to wait for the offers to come in. Obviously, the government will place these orders because otherwise they would not have been floating these tenders and specs here.
Yeah, precisely. That's what we are trying to understand. When can we expect that? Because I understand that it's up to government, and beyond the point, even you can't guide on that. I agree with that, sir. So second question, just was on commodity, if I can just squeeze in. So if you look at our gross margin and this or simplicity sales minus raw materials, if I use that, we are back to where we were in Q3. Now, is commodity basket similar to Q3 levels for us? Q3 F22 I'm referring to, or it is more driven by mix? If you can help us understand that.
No, what do you mean by commodity basket?
The entire steel plus aluminum plus some precious metals, whatever goes, some engineered plastics, whatever goes into your in making the vehicle.
Yeah.
Because our gross margin is a percentage. Q3 was around 22%, and we are again at around 22% in Q2.
Yeah.
So what is driving this? Is it because commodity basket has gone back to that level, or it is more of revenue mix which is driving it?
Oh, it is a mix of, there are three factors which will determine our margins, or maybe four factors. The first factor is commodity prices. If they are coming off sharply, then you will see the benefit of it coming in. But then the second thing is what is the level of inventory we carry, not only in raw material but also in WIP and FG. So nearly about, if you in this industry you will carry at least a month and a half of inventory, not in absolute inventory, not in finished goods, but in various forms, including potential orders that we have placed with vendors, right? I mean, we can't drainage on them, right? So that will happen. And in times of inflation, this also helps, right? We have seen that there is a lag in our commodity price increase. So this is the second factor. The third is, as Chairman had mentioned, the various initiatives that we are taking on VAVE across products to ensure that, we are taking cost out of alternative material or design, etc., which again is a continued improvement initiative that happens, right? The fourth one, which you rightly said, is mix. So there is a confluence of factors that determine the commodity cost. As I had mentioned earlier, we are looking at it on a vehicle-wise basis. Are we improving the raw material cost? We are looking on a vehicle-wise basis. Are we improving the net realization after discount? So while discount is one factor, we are saying, are we raising prices higher than the discounts to ensure that the net realization improves? While we are doing that, so on a vehicle platform basis, we are actually improving. What happens is if there is a mix change, suppose we sell a little more ICV in a particular quarter, obviously the mix will have an effect. So it's a confluence of all four factors. Yeah.
Okay. And lastly, on this industry volume growth, according to you, when does the base effect start kicking in? And what is the normalized kind of volume for industry you would be happy with for 24?
Sorry, can you repeat? What did you say? What kicks in?
The base effect, because as of now, we also had a favorable base for volumes. Hence, we are seeing a very accelerated volume growth. So from when does the base effect of volume start kicking, especially for medium and heavy vehicles? And F24, what is the kind of volume growth that you would be happy with as of date? I know that number could change from here on. But as of date, what kind of volume growth is what you would be looking at for 24 for industry?
If you look at, if I may take on that question, if you look at the last year, only Q1 was affected by the COVID. And Q2, there was a gradual increase in the total industry volume. Q1, if I recall, was around 30,000 vehicles, and Q2, it was around 53,000. And Q3 was 64,000. And currently, in the first two quarters, we have been doing at around 75 to 80,000 vehicles per week, per quarter. This is the situation. Then you can judge where we are with reference to the numbers which we have clocked in the last year. So the base effect going forward may not be impacting in a bigger way. So by the last year volumes, especially in Q4 was 94,000 and Q3 it was 64,000. So you will not see the base impact going forward in a big way.
Over to you. No, the only thing that we are saying is we have also seen reports here where saying that by the end of this year, as per forecasts, the industry would be close to the previous peak, which was about 390 or 395,000, right? And it won't be at 395,000. That's not what I'm saying, but somewhere maybe close to that. What it actually means is the demand maturity curve is actually catching up quite fast. The second one we must remember is that the size of vehicles have also gone up in comparison to what it was in the past. We have a lot more 49 tonners, 40 plus tonners, etc., which are actually having which is coming into the overall industry. I think we must also remember this is happening. You are right, and so is Balaji. There is a base effect in Q1 because last year Q1 was very low. So we've seen that happening. You are also seeing that this year, this quarter again, the growth has been there, but not at the same high level as Q1 of the Q1 period. So we should also be kind of clear that in the medium term, this industry is set to grow if the Indian economy is going to grow, because there is a multiplier effect vis-a-vis the GDP growth that we are expecting in the country to happen, and that's how we should actually plan our model.
Great. Thanks a lot for it, and all the best.
Thank you. The next question is from the line of Pramod Amte from InCred Capital. Kindly proceed.
Yeah, hi. This is with regard to working capital. Sorry to repeat this, considering that interest costs are going up. So it seems like almost like you added 2,000 crores into the working capital side. How much of that is towards the raw material inventory and how much is towards finished goods?
It is reasonably spread out here between raw material, FG, and receivables.
Added to that, yeah.
The point is, we don't provide that level of granular details. All we can tell you is that our working capital situation is very much under control. It is not, it is not in a scene where we have given you two data points. One is we are ensuring, and we have always ensured that in Leyland, is that our retail must be equal to wholesale, or retail should be higher than wholesale. Maybe a one-off month may happen where we have, kind of wholesaled a bit in the last day and the retail has not happened. But we keep track that we are not pushing stuff into the dealership pipe. That's very important, right? And the second thing is we also are ensuring that our receivables position is strong. We review the receivables position. We ensure that, the collectability of the receivables is fine and the aging is fine. And of course, as we mentioned, we are keeping a little bit of inventory to ensure that we are ready to serve the market in the event. Because there can also be missed sales, which is awful to have just because we didn't have the inventory. But I don't think there is any concern on the inventory side that you should get worried about. Balaji, how many days of sale is net working capital?
Roughly 5 days of...
It's not significant at all. It's just 5 days, yeah. The net working capital.
Yeah, Gopal, I appreciate, especially you have been managing and year-end you bring it back to literally a cash situation. The reason to ask is once you launch the Avatar platform, right? So there was supposed to be a lot of commonality of components and hence mix and match can be much easily done and cater to the marketplace. That was supposed to be one of the key reason to go for a modular, and hence the expectation that your working capital intensity should go down and whatever 300-400 crores you pay off in a year should also come in as a handy for you to fight out in the marketplace. So has it been achieved or you feel there is still a long way to go?
No, it is being achieved. It's not a long way to go. See, these things take time. See, you must remember, Avatar was launched. It's a good question. Avatar was launched on April 2020. April 2021 was nothing. It was a complete washout. 21-22 first half was a total washout. So only now 22-23 second half see this also takes a little bit of tryout. It's hard. So if you really look at the launch of Avatar and the fantastic performance that this this range of products are having in the market, the real play on the ground has been less than a year. If you really look at it, that has been the thing when the volumes have started to be kind of flow down into the market. The second thing is, you see, Avatar brings in not only the raw material, you are right, we will have fewer number of vendors, which is happening. We will have fewer number of parts, which is definitely happening. And let me tell you this, while you have not asked it, the modularity will be a strategic advantage for us when we are actually looking at even alternative fuels like hydrogen. Because what happens is the basic structure of the vehicle is it is adaptable without a cost or a significant cost. So you will see those benefits coming on the RM side or on the WIP side. But you cannot say that Avatar will result in lower FG or lower dealer stock, because that is a sales strategy, okay? It's not a manufacturing strategy. So modularity is more a manufacturing, quality, and serving the customer with various options that are available, and which is why again Avatar is doing well, because today we are able to offer vehicles that the customer needs. more than what he wants. We tell him his needs on a hub application segment basis, and they are very happy with the solution that we are able to provide. Balaji, you want to say something?
Yeah, on the working capital side, Pramod, we'll also have to take a look at the falling metal cost scenario. If we cannot stock high, but at the same time, no, we cannot also run on a depleted stock level. Depleted stock level will lead to loss of sales. At the same time, no, if we do a high stocking, then it becomes an issue, especially no, in the falling raw material price scenario. So we'll have to be extremely careful, and it is being managed very well, Pramod.
Sure. Yeah, thanks for the detailed answer. Second one is with regard to the demand front. Considering that you are a very strong player in the tractor trailer segment, which caters specifically to the export-import segment, there seems to be some weakness on the export front, and the things are changing much faster on the weakness there. So how are you seeing the demand specifically to that segment, and it does have an implication for your product mix and profitability?
In the export market, as you correctly point out, there are certain challenges as a result of the global scene. But we are seeing, in fact, many of the Middle Eastern markets continue to perform exceptionally well, and that is a segment that we're strong in. And we are also introducing new products into those markets, and we've extended the network throughout the African continent as well. Over the last 6-9 months, 15 new distributors have been appointed. So overall, we feel that we will end the year much better on the exports front than last year. And volumes will continue to grow as a result of the enhanced network and new distributors. And many more products getting introduced for the export market as well.
Yeah, thanks for that. I was also looking for your tractor trailer segment, which has exposure to more of export goods or import goods to that extent.
Which one? Tractor trailer. You mean the demand for the tractor trailer in India?
Yeah, exactly, because it caters to a lot of port traffic and hence export-import traffic.
It has been growing well, yeah. I mean, that's why I said we have been looking at it geographically and product-wise also. So if you look at our tractor trailer segment, we have actually looked at our market share there in that segment. Approximately, I'm giving you some numbers, has been about 10 basis points. I mean, 10 percentage points more. We've moved from somewhere around 18% to about 26%. So we have been doing well. I mean, across geography.
Yeah, and in fact, the overall share of tractor trailers, no, in the overall MHCV segment, that has also gone up. That has also gone up from 9% in 2021 to 13% now.
Cheers. Thanks and all the best.
Thank you. The next question is from the line of Vipul Kumar Shah from Sumangal Investments. Can you proceed?
Hi, sir. What is the share of spares business in our revenue?
What?
Share business will be around 7%, 7 to 8%.
7 to 8%.
8% of the overall revenue part.
Okay, sir. Thank you.
Thank you. Due to time constraints, we'll be taking the last question. It is from the line of Raghunandan from MK Global. Kindly proceed.
Thank you, sir, for the opportunity. Sir, my first question was on tractor trailers. As you indicated that company has been successful in gaining market share and slowly inching towards the 30% mark. Dealers indicate that Ashok's 4-cylinder vehicle has done well versus competitors' 6-cylinder vehicle. So just want to understand, how do you see this market share gain trajectory? Because we used to have more than 40% share in FY19. Do you see the recovery towards those levels?
Yeah, we'll see. I mean, you see, I'm not too sure about the 4-cylinder, 6-cylinder that you mentioned, but certainly you see all I can tell you is this: predominantly across the spectrum of products, but certainly across all zones, we have been gaining market share in the current quarter, and we will continue to pursue that growth as we move forward. Yeah, it's very difficult to say one segment, one particular thing, whether whether we will continue to get a particular target like 40%. But certainly, we want to ensure that we are getting into a higher and higher presence in the market, which means we have to enhance our broad strategy is this. Instead of just talking about purely MHCV market share, our broad strategy is to pursue domestic growth and share of business, but profitably. The second one is to grow our LCV business because LCV is a very, very important vehicle across the world. The third, for export, numbers as well, because globally, for every MHCV sold, we have about 3.5 to 4 light commercial vehicles sold. So it's a very important thing for us. The third one is also to ensure that we grow our international business. That's going to be very, very important. So we will pursue all three strategies, yeah.
Thank you, sir. On Hinduja Leyland Finance, so basically the segmental results have been improving quarter on quarter and year on year. Can you talk about the trend in collection, NPA, also the timeline for listing?
Yeah, you see, as far as the listing bit is concerned, maybe I'll ask.
The listing is expected, of course, based on all the regulatory approvals, probably around June of 2023.
Right, and as far as Hinduja Leyland Finance is concerned, it is continuing to perform well. Its total, AUM is around 31,700 crores. It posted an income of 1,620 crores and a PAT of 215 crores. Approximately about 13%, and its GNPA is at about 6.3 and an NNPA of about 4.4. Numbers are pretty good. And just as what Chairman had mentioned about the IPO that we are looking at post the merger with NXTL, which the company is looking at. The company has also already raised capital of nearly 910 crores from qualified institutional buyers. So there is no capital request now that will come up from HLFL to us. And secondly, they have sufficient capital for their growth. And we must remember there is another subsidiary called as Hinduja Housing Finance, which is a HFC which is doing exceedingly well, growing very fast. And we also have another joint venture between both Ashok Leyland and Hinduja Leyland Finance, which is called as Grow, where it's looking at solutions, both digital and financial, which we believe will be a multiplier effect for both our businesses. Both for Hinduja Leyland Finance as a finance company and Ashok Leyland as an OE. So, the erstwhile solutions business of Ashok Leyland has been transferred to Grow, and we have actually added some of the financial solutions, including freight financing, etc., into that. And you're going to hear a little more about that in the future.
Thank you, sir. Thanks for the detailed answer. That's all from my side.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to the management for closing comments.
I would like to thank everyone once again for your interest. As we said, we are very much on an upward trend in this industry. Our products continue to perform well across all segments. Market share has grown in each and every zone, and new products will be introduced on a quarterly basis. And we do feel that the growth that we have seen in the first 2 quarters will continue going forward as well. Thank you very much.
Thank you.
Thank you. On behalf of Batliwala and Karani Securities, that concludes this conference. Thank you for joining us. You may now disconnect your lines.